Retirement planning. Ugh, right. Talk about a headache. It's like, where do you even begin with all the 401ks and the insurance and trying to figure out how to actually enjoy yourself once you hit retirement?
It definitely can be overwhelming, trying to make sense of it all. There's so many moving parts.
Exactly. So in today's deep dive, we're going to try to unpack some of that. We're taking a look at this idea from, well, it's a little bit out there. It's about using whole life insurance to, get this, actually make your retirement plan even better.
Yeah, I mean, it's not the first thing people think about when they hear retirement planning, right? Life insurance.
Definitely not. But the source we're looking at today makes a pretty interesting case. So like, imagine two people, right? Both 40 years old. Both want to retire comfortably.
Okay, I'm picturing it.
One of them goes the, I guess you could call it the traditional route, maxes out their 401k contributions, gets a term life insurance policy, the basic.
Makes sense. Pretty standard approach.
Exactly. But the other person, they decide to do things a little differently. They get a whole life insurance policy. And because of that, they can't contribute quite as much to their 401k each year. Now, the source says that in a strong market, both of these folks, they end up with pretty similar 401k balances by the time they're 65.
Okay, so far so good. But I have a feeling there's a but coming.
Oh, there's definitely a but. What happens when the market takes a nosedive? That's where things get really interesting.
Because suddenly that guaranteed return on the whole life policy is looking pretty good.
Exactly. And the source gives a specific number here. The person with the whole life insurance, they've built up something like $210,000 in cash value.
Which they can access ideally without having to touch their retirement savings.
That's the idea. But I got to ask, like $210,000 sounds amazing, but what are the strings attached?
Right. There are always details, aren't there?
Always. Are there penalties for tapping into that cash value early? Does it mess with the death benefit? Fill us in on all the nitty-gritty.
Well, the specifics can vary depending on the policy and the insurance company, of course. But yes, you could have surrender charges if you withdraw too much too soon. And it can impact that death benefit, like you mentioned. It's definitely super important to really dig into those details. Compare it to, what you might earn by investing that money elsewhere. It's about making informed decisions.
Absolutely. Now, our source specifically mentions Lafayette Life. They call them out as a mutual company that offers these whole life policies. Can you explain what the deal is with mutual companies? Like, why does that even matter?
So think of a mutual company kind of like a co-op. Instead of being owned by shareholders, they're actually owned by the policyholders themselves.
So people who buy the insurance are the owners.
Exactly. And that means the company's main focus isn't on squeezing out maximum profit for those external investors. It's about looking out for the best interests of the policyholders.
Okay, I'm starting to see where this is going.
Right. It can mean better rates overall, and even better, policyholders can often get dividends. Basically, they get to share in the company's profits.
So it's like a bonus on top of the insurance itself. I like the sound of that.
Yeah.
Now, the source also throws out this age range, 35 to 45, as like the prime time to get whole life insurance.
Right.
Why those particular years?
Well, you want to think about maximizing the benefits, but also got to keep the costs in check, right? The earlier you get into a whole life policy, the lower those premiums are going to be spread out over the life of that policy.
Makes sense. You're locking in that rate for the long haul.
Exactly. And that sweet spot, that 35 to 45, you're getting those lower rates. Plus, you have more time for those benefits to really add up.
Gotcha. So it's not a one-size-fits-all kind of thing. Now, I noticed the source doesn't just talk about whole life insurance. They also mention using term life insurance in the mix. What's the strategy there?
It's like diversifying your investments, but with insurance. You use term life for when you really need it most, like during your peak earning years when you've got a family, depending on that income. It's cost effective, but just for a set period. Then, as you get closer to retirement, that's where the whole life insurance takes over. It gives you that lifelong safety net, financial flexibility you can rely on.
So it's about having the right coverage at the right time.
Exactly. Term life for the short term, whole life for the long game.
Smart. Now, there's one more piece of this puzzle I wanted to ask about. The source mentions pairing whole life insurance with annuities. How does that work exactly?
Okay, so let's talk about retirement income for a second. Annuities, they're often part of that picture, right? Because they give you a guaranteed stream of income. But here's the thing. If you want a higher payout from a single life annuity, well, there's a risk. If you pass away, those payments stop.
I see. So that's where the whole life insurance comes in.
Right. By combining those two, you can choose an annuity that pays out more during your lifetime, while knowing that your spouse, or whoever your beneficiary is is still going to be taken care of if something happens to you.
That makes a lot of sense. It's all about peace of mind, isn't it? Now, I know we've been talking about whole life insurance, but there are other types out there. The source mentions universal life and variable life insurance, but it seems like they're not big fans of those. Why is that?
The big difference is predictability and stability. Whole life, you've got those guarantees. Guaranteed growth, a guaranteed death benefit. It's like a safe haven. No matter what crazy stuff the market's doing, you're good. Universal and variable life, on the other hand, they tie your cash value to how the market performs.
So there's a chance to earn more, but also a chance to lose more.
Exactly. It's a riskier game. You could end up with a smaller death benefit or even have to pay more in premiums if the market tanks.
It makes me think about what happened back in 2008, 2009, during the financial crisis. The source talks about how people with whole life insurance, they were actually in a better position to ride out that storm.
Absolutely. Think about it. When the market's in free fall, having something stable, something that's not tied to Wall Street, that's invaluable. Whole life insurance can give you that stability, the cash you need, without having to make panic decisions like selling off your investments at a huge loss.
It's like a safety net in the middle of a hurricane. So, okay, I think I'm starting to see the big picture here. This whole idea of using whole life insurance as part of your retirement plan, it's really about building in that stability, having cash you can access, and maybe even seeing some growth, all without being at the mercy of the stock market.
You got it. It might not be the right fit for everyone, but it's definitely something to consider, especially if you're looking for more control and peace of mind when it comes to your retirement.
I think the big takeaway here is it's all about thinking outside the box, challenging those traditional ideas about retirement planning. What do you think? Could this shake things up, change the way we all prepare for the future? We want to hear your thoughts.